We come on strong with Mr. Greg Dickerson. How you doing, sir?
Doing fantastic. Michael, how are you?
I'm doing great, man. Thank you for being a part of this. Thank you for bringing your wisdom, creativity. Thank you for being a part of book number 2, right? 15 Conversations with Real Estate Millionaires. But what I want to talk to you about in this first video of 3 today is I expect a crash in transactions, but I don't see that also leading to a crash in price. I get a lot of questions. You and I sometimes disagree on where value and price are going, so I thought no one better to ask. You want to have that discussion?
Yeah, absolutely. I don't think we're going to see a crash of any sort or any, meaningful amount in housing because there's just so much pent up demand and not enough supply out there. There just isn't any inventory. So, real estate's hyper local, your Sun Belt areas, that's where the biggest demand is right now and the lowest amount of inventory is. There are a record number of units in the pipeline. So like I've been telling everybody, if you're going to see an adjustment, you're going to see it in new construction first because builders will liquidate. They can and they will liquidate the fastest and start cutting discounts. But you're talking about transactions. We're already seeing a little bit of a decline because rates, they're rising much faster than you and I thought. And,
oh, absolutely. Yes, sir.
My whole target's always been you will see a fundamental change in behavior at 4%. At 5%, that's just a whole different market. And, pretty much, rates get over 5%, that will really, really change the market in terms of values. You'll see a lot less demand. You'll see a lot less, ability for people to pay the same amount for housing, because that changes, what you can borrow by $100,000 if you're paying $2,000 a month, $50,000 if you're paying $1,000 a month, whatever your mortgage payment is, it really affects what you can afford to buy. So, as far as transactions, we're already seeing that dip a little bit. If rates continue to go up, we'll see it dip a lot a bit. But from a crash standpoint, you got to define that. What are you talking about? 30%, 50%? What do you really mean?
So I'm going to use 20% as kind of the number, right? Anything less than 20% is a correction, not a crash. 20% over is a crash in this very simple example. But this is kind of how I see it. So you and I,
mortgage applications are already down 15%. So are those transactions, and then if you look at pending sales, I think there was a report out the other day, pending sales is already down double digits, right?
Down 7% for the month on month. And I think it was 16% year on year, something like that. It's already happening. All right. So you and I have always agreed, right? As interest rates go up, the market's going to change. We were off by 1%, right? You thought at 5, I thought at 6, the game changes. But really what I see happening is I think rates are going to double, and they almost have, right? Off the bottom. I think the bottom average was 2.7%. And we already have mortgage rates for lots of borrowers at 5.4 or higher. So they've already doubled off the bottom. They could race to 6% before the year is out. And I didn't think that was possible, right? I thought they would top out in the low 5s, like 5.2. But where I'm going with this is, let's just say interest rates double. I think transactions fall almost immediately. To your point, we're already seeing it, right?
Interest rates double from where? What do you
so
mean?
They get to 6. They go from the bottom, they go to 6%, right?
Okay.
Snap our fingers. Sometime this year, they're 6%. I think that destroys demand, right? So I think less people can qualify. To your point, they borrow $100,000 less. Their pool of available properties that they could buy. But also, I think what is not being said is I think the consumer psychology, the thing that I followed for 30 years, is now damaged. And that's a big deal because now they're frozen in place. They don't want to move. I think we obviously have the war. We now have rates. We have, I believe double-digit inflation in reality. Lots of negative things. And I think the consumer is going to step back. I think they've been burned in the housing market because they've tried and didn't get. And this is the reason I think transactions collapse, is because we're also going to see the move-up buyer stay in place. And as you know, when a move-up buyer decides not to move, that impacts 2 or maybe 3 transactions, because when they sell, they also buy. And when that person freezes, that destroys the whole tree of transactions. So I really do think transactions are going to implode. I think transactions fall 25% this year. and could be down 50% peak to trough. And I think peak was 6.2 million shares. So we could be in the low threes maybe next year or the year after.
Yeah, it's interesting. So the buyers that will not be affected obviously are cash buyers. There's a large, what would be interesting to track would be, what percentage of the sales are cash, what percentage are strict, Wall Street investment firms, that have unlimited funding to buy properties, because those two segments of the market are not going to get taken out.
Correct.
Arguably, that'll pick up a little bit as prices decline and transactions go down. But that's not a huge portion. I think,
No.
Wall Street represents maybe 1% of the housing stock in the country, but
Mhm.
private landlords are a big chunk. That's probably 20%. People like
Yeah.
you,
Mhm.
that own single family rentals, and, your audience that are buying those types of properties. So, those people will get priced out of the market because it won't cash flow.
Yeah,
Unless you put a
exactly.
huge chunk of money down, and then your cash on cash return is nothing.
Yep.
It's going to affect the short-term rental market because those deals won't make sense anymore.
Yep.
And then it's going to affect your retail, permanent home buyer in terms of their affordability. So, like I said, we are seeing it now already. So what I said was 4%, you'll
Mhm.
start to see it happen.
Correct.
5%, you get over 5%, you'll see it fall off a cliff. The housing market will come to a complete halt.
Mhm.
And guess when that's going to coincide? Right around the summer, when the housing market dips anyways. It always
Yeah.
slows down in the summer in most areas. We're in the spring buying season, and you're already seeing it dip.
Yeah.
So it'll be interesting to see how fast rates go. I mean, I'm surprised we're almost at 5% now, and we're at that threshold. And that 5% that I'm talking about gets all the way up to 5.99. So
Yeah.
you're almost at 6.
You're right. Yeah, you're right.
But
Yeah.
if it goes over 6, yeah, I mean, it's hard to say what happens to transactions at that point. I mean, a lot of buyers are going to be taken out of the market. House prices aren't going to adjust that fast. I mean, prices aren't going to
Exactly.
substantially adjust between now and the end of the year, because most people in their homes either own them outright or they have very low debt, because most of the houses that have been bought in the last 3 years are sub 4%. And in the last year, what, twos? Sub 3% in the twos.
That's exact. The thing that makes housing an interesting thing, because I agree with you, naturally speaking or logically speaking, when transactions go down, you typically goose that by lowering price. Naturally speaking, that's an economic cycle. It doesn't work for housing, because that mom and dad who are living in that home, they got to live somewhere. And what we've just seen is huge rent growth. So for most people, it makes financial sense by hundreds of dollars to stay put. This market is going to lock up. When rates get to 6%, transactions are going to be few and far between, because not only is demand damaged, as we've talked about, but what I want to tell people is supply is going to be damaged. Because again, mom and dad, 2.8, 3.1% mortgage. They got to live somewhere. Yes, they're sitting on equity, but they won't flip and sell, because if they go somewhere else, they're going to have less in quality, less inferior, higher rent. It's what we are going to enter, because the Fed took rates too low for too long, is now a decade of ice age in housing, because demand is destroyed at 6% and supply is destroyed at 6%. The only people that are going to sell are the ones that have to. And that's, lots of people don't have to sell. Is that fair?
Yeah. There's a lot of people. Yeah. They have long-term low interest. So this is the biggest difference between now and 2008 and 9. And, we're not speculating, we went through 2008
Oh
and
yeah,
9, and
both of us.
I was right in the thick of it, very heavy. I mean, I had, I don't know, $30-40 million worth of real estate, at the time. And a lot of it were single family short-term rentals in the market that I was in. And I had some commercial stuff as well. And we saw it. The fundamental differences this time are, there was a ton of construction in the pipeline that was happening at the time. So real huge inventory levels. So that got wiped out. So a lot of builders were taken out of the market after 2008 and 9 and did not come back. So we have not kept up with the demand from new units with the population, and the millennials are the biggest buyers right now in the market. So that's a pent up demand that's there that we can't service right now. But there's record housing units in the pipeline right now that have been slowed down because of the pandemic and supply chain issues, that are going to be delivered at a price point, well above where the values are going to be by the time they get done. And a lot of those contracts are going to fall out. The other thing was subprime lending, in other words, lending to people that aren't qualified with little to no money down.
Mhm.
And, those no doc, no income verification, and then the exotic products, like negative amortizations, payment option, loans where you could pick your payment,
Teaser loans.
and
Yeah. Mhm.
short-term interest only.
Yeah.
So, we're not in that environment now. Most of the mortgages that have been originated, I think those short-term interest only are less than, probably 5 or 10% of the mortgage market.
Adjustable rate mortgages as initiated up to 2021. I don't have 2022 data, was 2%. So
Right. Yeah. So that,
98%
yeah.
fixed.
So I think this year it's even less because people are like, you'd be crazy not to get a permanent mortgage long-term at these interest rates. The other thing is we were in a, different environment from a work requirement relocation situation, relocating for work requirement situation. Now that's not a thing. People can work from wherever.
Yeah.
So people that have bought these houses, millennials that are locked in and they want to change jobs or careers, they don't have to move now like they did before. In the pandemic, we've worked through a lot of that relocation. And there's already like people going to New York and, there's apparently, those inventory levels have been, eliminated, the vacancies have been eliminated and there's, there's
record low vacancies in New York, 1.5%. Never seen it. Bidding wars for rentals.
It didn't take long for that to reverse course. And that's a lifestyle choice there, but that was a lot of people that left. Now they're coming back, that kind of thing. But, basically people don't have to move anymore like they did back in 2008, 2009. You had to move if you wanted to change your job. So yeah, it's a whole different environment, in terms of, it's really interesting because we have so little inventory and so much demand. But again, it's all because interest rates, and, people could, it wasn't like you got more for your money. It's just everything went up because money was so cheap, and it's everything all the way across the board. So
everything.
Again,
risk is being repriced right now.
Right. Deflation first, and now we're repricing. Yeah. So we're in the second leg of this. And the other thing that people forget, nothing has fundamentally changed from a monetary policy standpoint yet. We are still in a very easy monetary policy environment. Yeah. Rates are still record lows, not where they were completely, but I mean, it went up 25 basis points. We're only at an effective rate of about 0.37, from the Fed rate standpoint. And look how much mortgages have jumped on a 25 basis point hike because of treasuries. Treasuries are going through the roof because investors are fearing recession. So what are they doing? Inverted yield curve. They're going into long-term bonds, at a cheaper rate than short-term bonds. Short-term bond rates are rising because nobody wants to be in those. So and the Fed just recently stopped buying mortgage-backed securities. That's going to trickle through to the mortgage market. So it's going to be more difficult to get a loan. Those requirements are going to change. And, lending, requirements are going to be more stringent moving forward. So, that's the other piece of the puzzle that really affects what somebody can buy. The ability to borrow the money, cheap money, and, the Fed backstopping everything with those low rates.
Yeah. Again, I think one of the unintended consequences is going to be a 3 to 5 year period where if you're a real estate agent, real estate broker, mortgage broker, it's going to feel like the ice age, because I think we're going to go from 6.2 million transactions, and that's just purchases, not even including refis. And, that's going to go down millions of transactions.
Yeah. Refis are dropping through dropping like a rock right now.
Yeah. It'll be down 75% here pretty soon. I talked to a mortgage broker on Wednesdays, and I think it's 60% already going to 75. So
yeah. And they all went through it in 2008-9 when you couldn't borrow, nobody could borrow money. I
remember
that mortgage market changed fundamentally. And, a lot of people got out of the mortgage business.
Oh yeah. Yeah. So again, I think what we're going to suffer through is, we're going to see demand. Everybody sees demand destruction coming in real estate. I want to remind you that because of what's going on with rates, we're also going to have supply destruction. I don't think anybody is talking about that. Again, it is a very simple equation. Mom and dad sitting at home with their kids. They're in a house, 30-year fixed rate debt, less than the cost of rent. They are not going anywhere. People will not make financial decisions, generally speaking, that injure them. Housing is the largest expense for most people. They're going to go, honey, we're sending $1,200 off to Bank of America. Why would we send $2,000 off to the landlord? Let's stay put. So I think supply and demand get destroyed at 6%. Greg, how can people find you?
Yeah, gregdickerson.com. All my info is there. All my social media profiles. Go check it out.
Thanks, buddy.